going to be able here to highlight certain topics of Chapter 4, which concerns itself with completing the accounting cycle. We'll be mainly concerned with some remaining steps in the accounting cycle, which we haven't discussed yet, such as closing entries, which only occur at the end of a fiscal year. Also using a worksheet approach to simplify any period's preparation of financial statements, not just year-end. And we'll also be introduced to the notion of a classified balance sheet. The worksheet approach we'll look at is an optional device for accountants. It helps us prepare formal financial statements at month end or quarter end or year end. The topic of closing entries is only performed at the end of a fiscal year. This process prepares us for the upcoming new year in measuring certain activity. Finally, the classified balance sheet will introduce new terms as we divide up assets and liability accounts into certain groups with common characteristics. The 7 categories we see here will appear on our formal balance sheet that we make available to owners and other stakeholders of the business. First, to put this chapter in perspective, here's an overview of the accounting cycle, 9 steps. We spent most of our time so far in steps 1 through 5. We've also prepared 2 financial statements, the income statement and the equity statement. And so in this chapter, we'll concentrate on steps 7 through 9. We'll define what closing entries are and perform them, and we'll also produce a classified balance sheet according to the rules of accounting. First, looking at a worksheet accountants use. This is a multi-column worksheet, 10 columns. As indicated, it is not a permanent accounting record. There are several steps in this process, and the use of this worksheet is optional, although most accountants use it. This shows our 10-column worksheet and the 5 steps that we use to complete it. The first step is the development of the trial balance, which is simply the ending balances in all the accounts to ensure that all our debit entries equal our credit entries. The next 2 columns, column D and E, are adjusting journal entries, which we've looked at in Chapter 3. The work of adjusting journal entries entails a fair amount of analysis to ensure that our financial condition is properly stated. The third step, involving columns F and G, are simply a mechanical step that involves bringing over our updated balances of the trial balance, taking into account any adjusting journal entries in columns D and E. Step 4 is extending all our account balances in the adjusted trial balance to either an income statement, columns H and I, or a balance sheet columns J and K. We simply have to know which accounts belong in the income statement, that is, all revenue accounts, earned revenue accounts, and all expense accounts. And the balance sheet columns contain all the rest of the balances in our ledger. That is, individual asset accounts, individual liability accounts, owner's capital account, and any drawing account of the owner. In this worksheet approach, we'll see a difference between the debits and credits in the income statement columns. This is a difference that businesses desire, that is, an excess of credit revenue entries over debit expense entries. This results in measured net income. We will see that the difference in these columns are also needed to balance the last 2 columns in the balance sheet, simply because any profit or loss belongs to the owner's net worth area, the owner's equity area. Here's the start of our 10-column worksheet. The trial balance, again, simply comes from the ending balances in all the accounts in our ledger set of books. In the illustration here, our debit entries of $28,700 equal our total credit entries of $28,700. Our trial balance is in balance, and we can proceed to perform period end adjustments to update those balances. For our adjusting entries, we'll take the illustration problem in the previous chapter. Here's a listing of adjusting journal entries done to update financial condition. Now, we're not going to concentrate on adjusting journal entries this chapter. We covered that in the previous chapter. But I just want you to see that each of the adjusting entries either increases an expense account with a debit or increases a regular service revenue account with a credit. The offsetting entries to these entries are either an asset account or a liability account. The need for these entries have come about based on a review of our financial position at the end of any reporting period. So taking these entries and simply laying them into our adjustment column. Again, they come from balanced journal entries so that the sum of our debits equal the sum of our credits, $3,440 in each column here. The adjustment keys here, A, B, C, etc., simply show the balanced entry. So as we reduced our supply inventory account with a credit of $1,500, we increased our supply expense account $1,500. Effectively recognizing a use of assets during a time period, and therefore the associated reduction in owner's equity by use of an expense account at the bottom. Likewise, as our insurance periods lapse, the prepaid insurance asset account is reduced and insurance expense is increased with a $50 debit at the bottom. Now, I'm not going to go through each of these since this was the subject of last chapter's studies. Moving to the adjusted trial balance, this is simply the unadjusted trial balance totals in the first two columns, plus or minus the adjustments in our adjustments column. So we're just bringing across updated balances, no change to cash. Supplies have a remaining balance of $1,000, starting with a $2,500 debit balance before adjustments, a $1,500 credit entry, an adjustment entry, resulting in a balance of $1,000 debit after that adjustment entry is considered. Again, all the other accounts are simply bringing over the balances after the effects of the adjustment column. And again, we note that our adjusted trial balance remains in balance, 30,190 debits equal 30,190 credits. This third step of the worksheet is simply a mechanical step. The next step is to bring across the accounts that will affect the income statement, our service revenue account, $10,600, and all the associated expenses of the period indicated in the debit column of the income statement. This fourth step also brings across the remaining asset and liability accounts individually, cash, supplies, prepaid expense, etc., individual liability accounts such as accounts payable, unearned revenue, a liability account, revenues we receive from customers but have not performed the service, therefore we have not earned them yet in their liability position until we perform those services. Focusing back on the income statement columns, total credits of $10,600, earned service revenue. All the expenses total $7,740. That imbalance, excessive credits over debits, $2,860, is the net income for the period. At the bottom here, putting in that net income simply to mechanically balance the income statement that is not the subject of any journal entry. It's just a worksheet device. We can see that whatever is needed to balance the income statement, the 2860, is also required to balance the balance sheet. Again, as we've said, any net income or net loss belongs to the owner and will be reflected in our final balance sheet. Review question for the worksheet. Net income is shown on the worksheet in which column? As the difference between the income statement debit and credit columns here as a debit only to balance that section of the worksheet. It's also shown in the credit column of the balance sheet because we're giving owner credit for the net income or net results of the period, which are required to balance that particular statement. Again, this fifth step to simply mechanically balance the income statement, mechanically balance the balance sheet, is not the result of a journal entry, just recognizing the interrelationship between the income statement and the balance sheet. Logically, the income statement is prepared from the two income statement columns of the 10-column worksheet, and the balance sheet and owner's equity statements are prepared from the last two balance sheet columns of that worksheet. As financial statements can be prepared directly from the worksheet, simultaneously, any adjusting journal entry shown on the worksheet needs to be journalized in the general journal and posted or transferred to the general ledger as well. This illustration shows a formal income statement as developed from the worksheet. We developed income statements before. They're simply a report. They're not a journal entry. We're simply reporting our earned revenues, $10,600, highlighting them in the right-hand side of our report here, listing all our individual expenses, which total $7,740. Again, the two columns here are simply for presentation of data, not for a journal entry. They do not indicate debit and credit columns. The net of the numbers, 2860, is the net income or results of operation for our company for the month ending October 31st. Moving to our next statement, the owner's equity statement. In this case here, our Pioneer Advertising Agency was begun in the month of October, so there was no beginning owner's equity or owner's capital balance. During the month, the owner invested $10,000. We reflect that on this equity statement. We also reflect in a single number the results of operations, net income, $2,860, subtotaling that to $12,860, and then deducting any amounts in the owner's drawing account that they have taken out at their discretion during the time period. So the total owner's capital balance at the end of October, $12,360. Again, the owner's equity statement is very condensed, but is reporting on all four owner-directed activities: any investments during the period, any income earned, less any withdrawal or divestment from the business that the owner has made. The balance sheet then shows a balancing of total assets, $21,910, listed individually, equaling total liability positions and owner equity positions of $21,910. Note that the owner's capital balance of $12,360 is a single number used to balance our balance sheet, which comes from the equity statement. Now, we've yet to talk about the classified balance sheet, which we will shortly, and that will bring in some subtotals not shown on this illustrated balance sheet. Classified balance sheets with more subtotals are required by generally accepted accounting principles. This particular format you're looking at right here is not in conformance with GAAP, only because it's missing certain subtotals. Just to emphasize that any adjusting entries shown on the worksheet must be journalized and put into the books of the company. to keep in sync the balances developed on the worksheet with the books themselves. Again, remember that the worksheet is an optional device, not required, but commonly used by accountants. Let's turn our attention to closing the books. What does that mean, and when do accountants do it? First, we need to distinguish between the various accounts in our ledger. Some accounts are called temporary accounts. The remainder are called permanent accounts. At the end of an accounting period, and I'm referring to the end of the company's fiscal year, the company will make certain accounts ready for the next period. This is called closing the books. That is, the temporary accounts are closed out. Their balances are zeroed out. They're reset to zero so that they can begin to measure activity for the next year. The specific temporary accounts that are affected are all revenue accounts, all earned revenue accounts, all expense accounts, and the owner's drawing account. All the other accounts in the ledger are known as permanent accounts. They are not closed out at the end of a fiscal year. They comprise all asset accounts individually, all liability accounts individually, and the owner's capital account. We will see that our temporary accounts, revenue accounts, expense accounts, the owner's drawing accounts, their balances are all transferred into the owner's capital account at the end of a fiscal year. So that owner's capital account, as indicated, inherits a lot of activity, again, only at year end. Let's review what we mean by temporary. What does it really mean? Certain end-of-year account balances must be zeroed out, reset. Earned revenue, expense, and drawing activity are not carried over into the next fiscal year. Why not? Because they serve their purpose in the current year only. Their balances indicated are transferred to the permanent capital account of the owner at year end because it affects the owner's net worth. And these temporary accounts, therefore, will have a zero balance at the start of the next year so they can measure the next cycle of earned revenue, expense, and drawing activity. That's why they're called temporary. They only affect the current year's operation, and their balances must be transferred to a permanent account at the end of a company's fiscal year. Now, in preparing closing entries, these are balanced formal journal entries. Debits equal credits. It's a formal recognition of the transfer of any net income or net loss and any owner's drawing activity, the owner's divestment, into the owner's capital account. So net income or net loss and owner's drawing activity gets closed out into the owner's capital account, which is a permanent account. Again, as noted, these closing entries are only made at the end of an annual fiscal accounting period. I also want to comment on a term accountants commonly use. It's typical for an accountant to say, I'm closing the books for any period of time, be it a monthly period or quarterly period. This refers to all the activities of doing adjusting entries and positioning itself to prepare financial statements for any period end. This is not to be confused with the term closing entries, which are only done at the end of a fiscal year to close out temporary accounts. Here's an overview of the closing process at year end. We have 4 closing entries to be performed. First, looking at all individual revenue accounts, and there may only be a couple of them, closing out any balances in those accounts into a new account called income summary. We will simply look at the balance in an individual revenue account and make an opposite entry, debiting the revenue account and crediting the income summary. The second closing entry refers to all our expense accounts. Again, looking at the balances in individual expense accounts, there'll be debit balances, making the opposite entry a credit entry in individual expense accounts and putting one summary debit entry into income summary. The income summary account itself is a temporary account which is only used at the end of a fiscal year, and its balance will not be carried over into the next year. The third closing entry involves that income summary account itself. The balance in that account, and an owner would desire it to be a credit balance, that is, an excess of credits transferred from revenue accounts versus the debits transferred from individual expense accounts. That imbalance will itself be closed out and transferred into the permanent owner's capital account. The third closing entry. The last closing entry looks at the owner's drawing account, which we'd expect to have a debit balance, indicating that owner's equity or net worth has been reduced by an owner divestment or withdrawing assets out of the business. We're going to close that account out with an opposite credit entry and move a debit entry into owner's capital. In each of these four closing entries, we accomplish these by balanced journal entries, which moves the activity first of any revenue or expense into an income summary account. Next, we close out that income summary account into the owner's capital account. If it's net income, it'll be a credit entry into the owner's capital account. And finally, closing out the owner's drawing account, making a journal entry, taking its debit balance, crediting that account, and moving the debit into owner's capital. Owner's capital is the final standing permanent account in the owner's equity area. Note that the owner's drawing account does not go through income summary. Why? That withdrawal of assets is not an operating expense of the business. It reflects the reduction in assets like expenses do. However, it's not for the purpose of generating revenues. Therefore, it does not go through income summary. Let's illustrate each of these four closing entries at year end. This data comes from the balances in our earned revenue accounts and the balances in all our expense accounts, as well as the balance in our owner's drawing account at year end. So back at the adjusted trial balance, we had a total of $10,600 as a credit balance in service revenue. So we make the opposite entry and debit that account and make a credit entry to our income summary account, which is a temporary account. This has the effect of closing out the revenue account when we post that $10,600 debit into the service revenue ledger account. Second closing entries. Look at all our individual expense accounts and their balances. We had $1,500 in our supplies expense account. It's a debit balance. We'll do the opposite entry. We'll credit that account as we'll credit all our other expense accounts: depreciation expense, insurance expense, salary and wages expense, rent expense, and interest expense. Credit entries here will close out those accounts when they're posted into the ledger. The summary of all those credits equals $7,740, total of our expenses. We'll debit our income summary account. At this point, the balance in our income summary account is the difference between $10,600 credit in the first entry and $7,740 debit in the second entry. That difference, or balance in income summary at this point, $2,860, equals our net income for the year. I want to make an important point here. The author of the textbook is using data from a previous chapter to illustrate closing entries. Now, the issue here is that this data really represented in the last chapter only 1 month of operation, not the full year. So the numbers here are for illustration purposes only. As I mentioned, formal closing entries are only performed at the end of a fiscal year, not each month. So for this chapter, we are presuming that these numbers here are for whatever fiscal year is involved for the company. The third closing entry is to take the balance in the income summary account a $2,860 credit entry and zero that account out by making a debit entry to income summary, in effect transferring that credit into the permanent owner's capital account, 2860. The last closing entry, looking at a balance in the owner's drawing account, has a debit balance of $500. We'll make the opposite entry. We'll credit the owner's drawing account, $500, and debit the owner's capital account, $500. As you can see, the only surviving account here in the owner's equity area, that is a permanent account, will be the owner's capital account. Let's look at the effects of transferring or posting this journal entry into the ledger accounts themselves. Here we see all our expense accounts on the left, our service revenue on the right, and this shows the activity in these individual accounts after the closing entries have been posting or transferred to these ledger accounts. The closing entry on the prior page had us debit service revenue, $10,600, and credit income summary, $10,600. The effect of that is to equalize the debits and credit values in service revenue, or render that account to have a zero balance. Likewise, the individual expense balances, taking supply expense as an example, it had a $1,500 debit entry before we made the adjustment or the closing entry of $1,500 credit. Depreciation expense had a debit balance of $40. We credited for $40, the opposite entry. And for all the expense accounts, whatever the balance was on the debit side, the closing entry credits those accounts, rendering the total debit entries and total credit entries to be equal. That is, each individual expense account, after the closing entry is transferred or posted to the ledger accounts, are zero. The income summary debit, one debit offset, $7,740, is seen as a debit in the income summary account. The third closing entry looks at the income summary account itself, also a temporary account, only at year end. It has a balance of $2,860, meaning it has an excess of credits over debits. So our closing entry is to place a debit entry into that account, $2,860. The credit closing entry, $2,860, into owner's capital account, the permanent account. So the income summary account is also closed out in our third closing entry. The last closing entry involves the owner's drawing account. We had credited for $500 in the closing entry, which made the credit amounts equal to debit amounts, or a zero balance in that account, effectively transferring that debit balance into the owner's equity capital account, $500 debit. This closing process has rendered all our revenue accounts, earned revenue accounts, all our expense accounts, and the owner's drawing account to have a zero balance. So as we begin operations for the next year, we can begin to measure new revenue and new expense account activity and new drawing account activity of the next fiscal year. That's the primary purpose of closing entries, to ready those accounts, those temporary accounts, for use in the next fiscal year to measure reports in that period. So to recap our closing entry process, again, they're normal journal entries. Debit values equal credit values. They're balanced. 4 separate closing entries, only used at the end of a fiscal year to reset certain accounts to zero for next year's measurements. Focusing on the income statement and the equity statement. Those are the statements we want to look at activity anew in the next fiscal year to determine changes in the owner's net worth because of that activity. Now, once those closing entries have been transferred to the ledger, businesses will do a post-closing trial balance, a trial balance after the closing entries have occurred. Again, to ensure that our total debits equal our total credit entries in all our accounts, Note the absence of temporary accounts in this post-closing trial balance. You will see no earned revenue account, no expense account, no drawing account. The effects of all those accounts have been closed into the owner's capital account. What we're looking at here are only what's called permanent accounts, accounts whose balances will carry over to the next year as shown. Again, looking at the balance sheet we saw just previously, the owner's capital, $12,360. That's the only permanent account in the owner's equity area that remains for our financial reporting purposes. That owner's capital balance has inherited all the activity from revenue and expense accounts, less any drawing activity by the owner. I'd like to make a brief comment on correcting entries. If errors are discovered throughout the year, they are corrected as soon as they are discovered. That is, we simply change or adjust the accounts that are needed to correct any error. Perhaps we made an expense entry backwards or any other entry with incorrect amounts. As soon as they're discovered, they're corrected. This should not be confused with normal and routine adjusting journal entries done at the end of any month end or quarter end or year end, or routinely updating financial condition in preparation of formal financial statements. Errors can occur as books are maintained. When they're discovered, they should be corrected. The last topic I want to highlight in Chapter 4 concerns the classified balance sheet. As we've learned earlier, a balance sheet is a snapshot at a point in time of our financial condition. The status of assets, the status of liability claims, the status of the owner's equity residual claim. A classified balance sheet simply introduces certain subtotals, certain groupings of assets and liabilities to allow a reader to better understand the financial condition of a business. So the grouping of assets, as shown at the bottom, we'll have a grouping of assets called current assets, long-term investments, property, plant, and equipment, and intangible assets. Likewise, on liabilities, we'll break liabilities down into current liabilities and long-term liabilities. These are the only subgroupings affected in a classified balance sheet. The owner's equity or owner's capital position remains unchanged, but presents itself as one number on a final classified balance sheet. Are all these subtotals meaningful? The answer is yes. It provides readers with a quick view of certain relationships, especially the relationship between current assets and current liabilities, and we'll define those shortly. It's out of the current asset and current liability section of our balance sheet that day-to-day activities of the business are conducted. We'll see that the grouping of assets, in effect, ranks our assets in terms of liquidity, how quickly our assets turn into cash. That allows us to answer questions, is the business solvent? That is, can our current debts be paid with our current assets? To illustrate a classified balance sheet, we're looking at an example out of the chapter, illustration 418. This is not the same Pioneer Advertising Agency set of financial statements that we looked at just previously. But what I want to show here is that Franklin Company had a total asset position at the end of October of $61,400. Now, to conform to generally accepted accounting principles, we simply can't list all our asset categories totaling $61,400. We must group them, divide them, provide subtotals. You can see here we have 7 items that are grouped in what's called current assets. We have a couple of accounts in long-term investments, 3 accounts in property, plant, and equipment, and 1 category of intangible assets. We'll be going through these definitions shortly, but I want you to see the effect of a classified balance sheet. Assets that have subtotals and not just a listing of all assets into one grand total of 61.4, but a subtotal of current assets, 22.1, long-term investments, 7,200, property, plant, and equipment, $29,000, and intangible assets of $3,100, totaling our total assets of 61.4. Likewise, looking at the claim side of our balance sheet, liability positions and owner equity positions, we see that we have total liabilities of $27,350, but we have a grouping here, a subtotal of total current liabilities of $16,050 and other long-term liabilities of $11,300, totaling $27,350. Bringing in our one owner's capital balance of $34,050, our total liability and owner equity position, 61.4, equals our total assets on the previous page. Now let's begin to define exactly what these groupings of assets and liabilities mean. First, current assets. Current assets are defined as items a company expects to convert to cash or use up within 1 year or the operating cycle, whichever is longer. As indicated, the operating cycle is the average time it takes from the purchase of inventory to the collection of cash from customers, a cash cycle. Typically, there can be several operating cycles within a 12-month period for a company, and so current assets are defined in terms of assets that are expected to turn themselves into cash or be used up within a 12-month period. As noted at the bottom, assets are usually listed in the order they expect to convert themselves into cash. Review question. Cash and other resources, assets, that are reasonably expected to be realized in cash or sold or consumed within the business within a 12-month period are called current assets. Long-term investments are a category of assets that I'm not going to spend too much time on in this chapter. They're simply investments in, as indicated, stocks or bonds of other companies. It's commonly due to having temporary excess cash that a company wants to earn some money on rather than just be in a checking account not earning money. They'll be temporarily invested in certain investments. The category long-term investments simply means that the company expects to keep that investment for more than 12 months. That's why it's not in the current asset category. In other words, they don't expect to sell it within 12 months, but to hang on to it longer than that. Therefore, it cannot be classified as a current asset. That's not going to be turned into cash within that 12-month period. Property, plant, and equipment. These are assets that have long useful lives, physical substance. They're used in operations. They're not for sale. It's not inventory bought for resale, but items such as land, building equipment that's actually used in the operation of a business. This grouping itself are the primary productive assets of a business. We'll learn later in another chapter, sometimes they're called fixed assets. The cost of these assets are used up or consumed over time, and over time we'll prepare depreciation expense entries which reduce the owner's equity category, and we'll take a credit to accounts called accumulated depreciation, contra asset accounts, which reduce our property, plant, and equipment. So as assets go down through credits to accumulated depreciation, owner's equity goes down with debit entries to depreciation expense on the other side of the equation. We'll be coming back to depreciation expense in a later chapter, nothing other than the systematic allocation of the cost of property, plant, and equipment over its useful life. Here's an illustration of the property, plant, and equipment asset category on a balance sheet, on a classified balance sheet. Land and land improvements, buildings, machinery and equipment, other property, plant, and equipment assets here, cores and rings, subtotaling $2,244,508, less the contra asset account accumulated depreciation $1,252,692 for a net book value of $991,816. Again, property, plant, and equipment is simply a group of assets used in the business to conduct operations to earn a profit. Final category of assets, intangible assets. These are assets that are used in the business that do not have a physical substance. This category represents acquired assets that are used in the business but simply lack the physical substance of property, plant, and equipment in the previous category. Again, all the groupings of assets simply have common characteristics. We looked at 4 of them. I'm not going to go into the detail of intangible assets such as goodwill. That's a subject of advanced accounting, which we'll not get into in this course. Review question. Patents and copyrights are what type of assets? They fall in the category of intangible assets. Of the 4 categories shown here, only current assets are items that represent cash or items we expect to turn into cash or use up within a 12-month period. We'll find that current assets and our next definition of current liabilities are very important to a classified balance sheet. So let's turn our attention to the liability side. What are current liabilities? These are obligations, legal obligations due within the next 12 months or operating cycle, whichever is longer. As indicated, usually items such as notes payable, borrowings from the bank are listed first, followed by other items. The focus of this category are debts that are due within 12 months, and so it shows, in combination with current assets, the company's ability to meet their obligations as they become due in the next 12-month period. This simply illustrates a listing of current liabilities. Again, totaling $127 million. Notes payable first, followed by accounts payable and other items due within 12 months. I want to point out something here, that third line, current maturities of long-term debt. When we look at the next category of non-current liabilities or long-term liabilities, we'll also see a long-term debt number. Now, the $57,250 that we see here comes from the same account that another number on the next page comes from. The total of long-term debt in this company's balance sheet totals $60,625,000. However, $57,250,000 are due within the next 12 months, and therefore they're classified as a current liability. Parts of this long-term debt that are not due in 12 months will fall into the long-term liability category, not the current liability. So what we're doing here is, in certain accounts, having to split their classification of items between current liabilities and non-current or long-term liabilities, all based on when they're due. Moving to the second grouping of liabilities, long-term. These are obligations, again, legal debt the company is expected to pay, but after 1 year, beyond 12 months. Here we pick up the other portion of long-term debt, $23,375,000. That in combination with the previous long-term debt payable within 1 year, $57,250,000 equals $60,625,000. That would be a single account, or could be a single account within the ledger, but it's split here because this portion is not due within 12 months. It's long-term and therefore shown in a separate category. Review question. Which of the following is not a long-term liability? Bonds payable, current maturities of long-term obligations, long-term notes payable, or mortgages payable. The current maturities of long-term obligations are not a long-term liability. They'd be classified as a current liability. All the other three items would be classified as a long-term liability on a classified balance sheet. Again, the distinction simply being, when is that amount due? Due within 12 months, current liability. Due beyond 12 months, long-term liability. The owner's equity area is not affected by a classified balance sheet. For the sole proprietorships we've been looking at, there's one capital account, owner's capital account. The illustration here from Nordstrom is bringing in a corporation owner's equity area, which is more complicated than a sole proprietorship. I'm not going to discuss the distinction between capital stock and retained earnings, other than saying that in what we've been looking at to date, there'd be one owner's capital balance shown, and there'd be no splitting of this in terms of a classified balance sheet. A single number for sole proprietorship would balance the balance sheet. These last slides simply are pointing out the fact that the International Financial Reporting Standards, a group which is headquartered out of London, currently converging international standards with U.S. generally accepted accounting principles, uses the same closing process that we do in the U.S. Now, there are some differences between the international standards and U.S. standards. For instance, at the bottom, we see that the International Financial Reporting Standards have similar categories, but they list them in a different order. In the U.S., current assets would be at the top of the balance sheet. Current liabilities would be at the top of the liability section, not in the reverse order shown here. That is the international standard. The important takeaway is that the international standards and U.S. standards have similar guidelines distinguishing current assets and non-current assets, current liabilities and non-current or long-term liabilities. But as indicated, the international standards reverse the order of those listings within the statement. This course does not emphasize the international standards, but current assets under the international standards are listed generally by the reverse order of their expected conversion to cash, unlike U.S. statements. Not illustrated in these slides is the relationship between current assets and current liabilities. A classified balance sheet showing those totals separately gives any reader the ability to look at current assets compared to current liabilities and do a ratio. So current assets over current liabilities would give a ratio of 1, meaning that there's $1 current assets for every $1 current liability, indicates the company would have the short-term ability to pay all their debts due within 12 months. Current ratios above 1 show a better ability to pay obligations due within 12 months. Current ratios below 1.0 would indicate that a company might have difficulty paying its current liabilities from its current assets, simply because there's not sufficient current assets at a point in time to meet their obligations at a point in time. That in itself does not indicate the insolvency of a company, just that it's a higher risk of being insolvent if that condition persists.